You don't want to invest without getting the right education.
I keep my conversations strictly business with my investors. When you're raising funds, don't be discouraged.
Welcome to another edition of Ask the Multifamily Expert. Today, I am super excited because one of my weaknesses is raising capital. Today, I decided to bring someone that is a fund manager to walk us through the entire process. Most of you that are currently in the multifamily space, you know one of the critical factors for you to have a successful deal is capital raising. If you don't have that, then your good deal is as good as done. So it's a very critical aspect, and it's very important that you partner with the right set of people that are good with raising that to work with you to get you to the finish line. Currently in the economy, we are seeing things happening. We are seeing investors that are pretty scared of the economy or pretty scared because of some experiences that they're going through. But truth be told, there are some people that are still excelling in raising capital or building a fund. So one of the ways of doing a multifamily deal is not just through the syndication. So syndication is getting a pool of investors, getting their monies together and closing on the deal. But there are other ways for you to close on your deal aside from going through that route. It's called through a fund. And we have with me someone that is a fund manager. So he's going to walk us through the entire process. Joseph, I'm super excited to have you because I also want to know about it. It's not my comfort level, so it's something I'm really, really interested in knowing about. And I'm sure the audience are also in my shoes. Some of them are also in my shoes and all that. But before we get started, I would like for you to tell us who exactly is Joseph Kimbrough.
Yes, so who I am exactly. I would say someone who loves to travel. I love spending a good amount of my time in East Africa. I have yet to go to West. That is on the list. Also, former Marine, love to shoot rifles. Still do that on a regular basis, about 1 to 2 times a week. Got to keep those skills sharp. You never know. So, yeah.
So what is a former Marine doing in multifamily, not just in multifamily, in raising funds? How does that relate? Because I can't just imagine someone that was formerly in the Marine doing this.
I guess the question would be, how did I get started?
Exactly.
Yes, so I started off after being in the Marine Corps for 4 years. I went into single family real estate as a wholesaler. So the people who find deals and then you sell those deals to investors. And that's how I got started in the real estate space. Now, I also had a background in insurance where I learned, different insurance products and, wealth management things. And so I ended up saying, okay, I want to own a fund. How do I get from being a wholesaler to owning a fund? So I started asking questions. I started going into multifamily, taking courses for multifamily because I always knew I wanted to get into buying large apartment buildings. And so then I ended up going to an event and networking with the right people. Went to an event and ended up setting up a fund with their help and started raising money and then investing into these apartment buildings. So my first building was 160 units in Charleston, which I have a story about that one.
No, you tell us the story shortly. I'm happy that you went through because I just wanted to ask you, why did you choose to go into funds instead of the regular? Because most people that we see, they like to analyze, they like to do the underwriting, they like to source for the deals, but yours was direct. I want to do funds. You just answered that and all that. So my next question to you is, walk us through the entire process. How do you start a fund? What are the things you need to put in front of you, take cognizance of before you go through the entire process? So give us a step-by-step process of starting a fund.
Literally, right before this here, I kid you not, I was on a Zoom call with an attorney to set up my next.
Oh, okay.
Yes.
Nice. Okay, so tell us, how did it go? What do we have to do for anyone that's willing to set up a fund?
Yes, so it's really just, you have to speak with the attorneys. You have to make sure it's an attorney that's good at what they do, because if it's not set up right, it can expose you to different legal problems. Also, when you set up a fund, you have to put together a pitch deck with the buy box, and you have to let people know, hey, this is exactly what we're investing in. And there's pros and cons. So setting up a fund can be more difficult because it's a blind pool fund that you're setting up. So you don't have an asset saying, hey, invest your 100 to 250K with me. This is exactly what it's going into. You're coming to them with a pitch deck and saying, this is what I project I'm going to invest in. And if you're able to invest, then this is what you're investing in, but there's no asset for you to invest in. You're just investing into this bank account. So you see how that can be difficult, right?
It is. So are you saying that just with a pitch deck, you're able to get people to give you their ad-end money? Just like that?
Yes, exactly. And it's all about the trust levels that you build with the person, because when you're managing fund, they have to trust your ability to do right with the money, to invest in the right assets, because they themselves are saying, okay, we're relinquishing the ability to choose what investments we're investing in. We want you to choose those investments because we trust that you can make the right decision. And also it can be other like barriers with it when you are in that position, because quite frankly, I started my fund at 28 years old. Most of the people with the money to invest in a fund, they're 40s, 50s, mid 40s, 50s, maybe, somewhere close to 60, right? You're speaking to a 28-year-old. I trust you to handle my money. Yeah, so it's a lot more barriers to accomplish. So you have to go the extra distance to build that trust with and be as transparent as possible.
Okay, so going by what you're saying, the pitch deck, yes, does the magic, but relationship goes a long way.
Relationship goes a long way.
Okay, good. Let's go back to the legal part. Like when we're doing syndication deals and we're pulling funds from different investors, there's something called the 506B and 506C that is for accredited and non-accredited. So for a fund, is it the same way? Can anybody just invest in it if they are not accredited investors? But before you answer that, let me just explain to the audience what is accredited and non-accredited investment. So an accredited investor is someone that has a net worth of $1 million, excluding your household, or you and your wife, couples, you make at least 300,000, or single 200,000. So that would qualify you as an accredited investor. And it must have been for the last 2 years. And you also know that your next tax return will also state that you're going to make the same money or more. But for a non-accredited, you don't make as much. You don't make up to 150,000. You make below 150,000 as a non-accredited investor. You don't have a net worth of $1 million as business, or you don't even earn that amount and all that. So you are classified as a non-accredited investor. This is a summary. There are some other ways to describe it. So back to you, Joseph. How is it with funds? Is it the same 506B, 506C?
Yes, and you have multiple ways to set up a fund. So are you setting up a Reg D offering or a Reg A offering?
Explain. So can you break that down for us?
Yes, so if you're doing a Reg D offering for a fund, you're either doing a 506B or a 506C. Now, I began with a 506B. I would tell you, you cannot market a 506B. If you don't have a bunch of rich friends and family, that's about the worst fund you can possibly set up. Because imagine going to your family and friends and saying, hey, do you have 100,000 minimum to invest? And they don't so I had to switch that fund over to a 506C as quickly as possible. Both has their pros and cons. A 506B, you can't market, but you can accept non-accredited investors. A 506C, you can market, but you cannot accept non-accredited investors. So I had to tell all the investors who were interested that were non-accredited, they wasn't moving fast enough to invest in the fund. I told them, look, y'all have 30 days. If you're not ready to invest, this thing is being switched over to a 506C because I have to market and I have to raise money. And so that's the benefit. Now, with Reg A funds, those are beautiful.
That is the accredited one, correct?
That a Reg A fund.
What's that?
You don't have to be accredited, but you can market to the masses, to the general public, right? Now, with a Reg A fund, people can invest as little as $2,000. Now you're setting it up and you're capping that fund out at $75 million, right? But you're able to market that fund to all over social media. Hey, invest with me, invest with me, invest with me. And it's ran different. It's more of a REIT than it is a...
It's like crowdfunding, correct?
Exactly. It's like crowdfunding, but it's at a bigger level. Crowdfunding A crowdfunding fund it's $5 million max. So Reg A is 75 million.
Okay,
So that's the
Reg is
biggest
75.
difference.
Okay, that's the difference. So what are the challenges with Reg A?
With Reg A, I mean, to raise 75 million, you're going to have to put together quite a bit of following social media, or you need to have friends who have a following where they can promote that for you to get the investors in. So you have to have a strong reputation. It can be a bit of a hassle to get to that 75 million when people can invest $2,000.
You can say that again. How do you identify a potential investor for your fund? Definitely, I'm sure you're not looking for the $2,000 investor. What's your niche like? And for other people, how can they create their own niche? Because I know you have a niche. So tell us how we can do that.
Yes, so the niche that I normally go for is business owners and professional athletes because I can be in both spaces. Like I know professional athletes, I've spoken with them, we speak pretty often. Also business owners, I'm a business owner. I had a business before that, so we're relatable. I played basketball all throughout high school, some college. Before going to the Marine Corps, I would still hand the person an L on that basketball court. So it's just being very relatable. So you have to choose a niche that you're relatable to. Ironically enough, look like I could have played in the NFL. So
Exactly.
I blend in with a lot of NFL players. They asked, as a matter of fact, I was at an event once with a few of them, and someone asked, "Hey, which team do you play for?" I'm like, well, number one, if you have to ask that question, I am in the NFL, I suck.
Really? Guys, so you know, when you see him, you see LeBron. When you see him, that's the type of person because he has the build of an athlete. So I can imagine that you appeal to those kind of people. But what about people like me that are fully into multifamily? We're not into professionals, like in the professional fields like doctors, accountants, and all that. We are not into all that. What kind of niche can we build for ourselves? Not family and friends, please. What kind
I
of niche?
recommend. I would highly recommend that you build a niche with business owners and also get in contact with the right kind of business owners. Now, I would even go as far as people in the finance space. One of the things you want to get invited to is invite only events. So I get invited to invite only events. Now, why is that? Because invite only events means it's going to be a more exclusive group of people, more of a intimate type setting. You're there, you're meeting with these people. You're gonna throw on a blazer, more than likely you're gonna dress up more. But chances are everybody at that event has the money to invest with you, and they're not in real estate. You don't want to be in real estate. You don't want to be at real estate events. Spend as little time at real estate events as possible, unless you're looking for partners. If you want to raise money, you have to stay away from those. Because even if at a real estate event, there is a limited partner who wants to invest. Think of it this way. There's the woman that every single guy is looking at. And now all these men key in on this one woman and they all go talk to her. They all shooting their shot. Now she's sitting there, shoot. He was a good fit, but I didn't like that gesture that he made. So now I'm gonna go to this or I'm gonna go to that one. I'm gonna look at this one now. She has there's way too many options. The chances of you being the person that she chooses is lower. You want to go where you're the only option.
Right. What you're trying to say is that we should take advantage of invites only kind of event. People like me, having double of us in such an event will not make us to achieve our goal. For someone like me that is an introvert, I have this mentality that fundraising or capital raising is not for everyone. My question to you with that is, can everyone really raise funds? Is it for everyone? Like everyone, especially when you're not the outgoing type. I can count how many events I've been to. So.
So if you're not the outgoing type,
yeah.
I would say capital raising is still for you because there's investors who are not the outgoing type, but they might have shown up to an event. And if you're an introvert and they're introvert, there lies a connection.
So what you're saying.
Also, if you're going to take that approach, that's actually beneficial because when you're at the event, you're not going around speaking to every single body. You're kind of more reserved, and the right person, when you're in the right room, will come up and speak with you. And the chances of you closing that one person is higher. So let's say they invest 200,000, but then they tell their friends invest 200,000. Their friends tell their friends. So you can grow from a different perspective. So it doesn't matter if you're an introvert. You just need the right person who's going to talk about you to their friends who also have the same kind of money.
I'm happy you went that route. You spoke about relationship at the beginning, and I'm going to narrow it down to this. Can you share any tips on how to build and maintain relationship with investors? When is communication too much? When do you start withdrawing your communication because it's not becoming too much?
Yes, so I keep my conversations strictly business with my investors. And I will give you an example of how I got one investor. This guy, we had just met through an online networking event. We scheduled a Zoom call. We had the Zoom call. He's never met me in person. He invested $100,000 into my business. Now, that's based on business relationship that we had because he saw that I was transparent and he also saw that I am very straightforward and direct with my approach. I have nothing to hide from you. This is what we're going to do. Do you want to invest? I'm not doing too much to overly impress because when you do that, now they're saying, if he's doing all that stuff to impress me, to invest with him, this might not be that good of an investment.
Sure. Fine. Well, what about not even communicating at all? So is there any standard for communication? Is it once a week, twice a week, once a month, or never?
Once a month. Once a month.
Okay.
And it's really just an email. I send an email out once a month to the investors about the performance. If someone wants to reach out and have a conversation with me, that's possible. I do have some investors that reach out from time to time and they'll text me or they'll say, hey, can we get lunch if they're local? But that's not an everyday thing. We don't become best friends.
Mm-hmm. So let's go to another aspect. Like I started, my intro was about the economy situation. Many investors right now are scared. Some of them have been disappointed. Some of them have lost their entire money due to foreclosures and all that. Now, raising capital has become a lot more difficult. That means whatever you've been doing for the last 2-3 years when we had a lot of money in the economy, you have to do it like 10 times now. How have you been able to manage those kind of challenges? What are the things you're doing right now to get them to become comfortable in investing with you?
The life cycle of an investor, it can take a little bit longer now at this point, but you increase the education. One of the biggest benefits is being able to write articles with Forbes Business Council and then posting that out there. Also writing articles that go to LinkedIn, writing as much information as possible, doing podcasts, getting out there more, doing webinars, putting yourself out there more with the education. That's how you can get them as comfortable with you as possible. But you just have to work a little bit harder than what you would have before. And for me, myself, I learned this lesson starting my fund out the gate because transparency, invested into a property, that property, they can't pay distributions, right? So they say, okay, no, we can't pay distributions because the debt is too much. So I'm like, well, how do I do this? Now, when this is your first fund and your investors speak to you and you tell them, hey, I can't pay distributions off this property I just invested in, just the first property. You understand how that can go, right? They're looking at you like, wow, that was not a good choice. So you have to change your strategy. So what I do is I work with different groups. And, what I've noticed is that assumable debt on properties has become more popular. And so that's something that I would say that makes my investors more comfortable is that they see that I'm more creative because I had to learn how to be creative out the gate.
Okay.
To prove to my investors that, hey, this was not a mistake investing with me. I just invested and I'm not going to put all that out there.
Now that you've said that, how do you go through your due diligence? How do you see out the bad ones? What is your due diligence process for your operators before you can jump on your deals?
Well, one, I want to see the deals that they've already done. That's number one. I want to see the underwriting for those deals. I want to see the underwriting for the deals that they're putting in front of me. Also, I would say too, my spirit of discernment is strong. And so if I feel like a person is too anxious, then I'm always thinking, I'm like, okay, they look too anxious. What's going on here? I need to look deeper into these people. So, you got to do the background checks.
Sure.
When you're doing those background checks to discover these things with people, you're like, okay, you want to look more into them. You also want to meet them in person. That's another thing. I meet most of my operators in person. I want to know their backstory. So those are the due diligence that I look for.
Now, as a fund manager, the way we structure syndication is different. We have co-GPs coming in, or the GP or the sponsor to raise funds. So how does that work with fund management? Because you structure it in such a way that you can bring in other people. Let's assume you're raising a 100 million fund and maybe your capability is 50 million. And so that means you need more partners to come in to help you raise a 50 million fund. How would you structure that to accommodate them? And how does does that work?
To raise a $50 million fund?
$100 million fund. Your capacity is 50 million. You can't raise 100 because that's your capacity. You need to raise 100. For you to raise 100, that means you need to partner with some other people to come together for all of you to raise it. So how does that work? I don't even know.
Now that gets you into a whole new world when you're raising $100 million or $250 million fund, which I'm actually putting together right now, a $250 million fund. That's a whole new territory. Now you're dealing with family offices who might want a piece of the fund.
Exactly.
You see what I'm saying? So you have to structure it a little bit different and already have that room created where if need be, you can give up a small amount of equity in order to raise a large chunk of cash into that fund. You also want to have relationships with different people in the financial space. So me personally, I don't just know fund management. I know how to deal with stuff in the wealth management space. I understand the insurance space. How does index universal life insurance plans work? That way when I'm speaking with people, I can recognize the opportunities to say, hey, you know what, if you connect me with this person, then I know this person will have the capital to invest with the fund. And if you connect me with this group, so when I'm speaking with these family offices, they're not looking at me saying, hey, I'm just speaking to another fund manager that wants our money. They're saying, hey, this guy, he might be younger, but he knows his stuff.
Yeah, I'm really enjoying this. We have about 5 more minutes for this, but I think I have 2 more questions before we wrap up on this. How do you structure your deals to make it very attractive to your investors?
Yes, so one of the operators I work with, the way they have this deal structured, this is something else I look for with operators. Are they creative with deal structure? Or are they just going to do the same boring thing, cookie cutter that everybody else do? And so this group, they do a 10% mandatory return on your investment. So you can invest in the mezzanine debt portion with this here group. And then you turn around and in year 3, they start paying you a 16% pref. So what that's doing for them is saying, hey, we're going to give these people a 10% mandatory return on their investment for the first 3 years to cut like that way they're comfortable. We get them in the door. Then we turn around and we're going to give them a 16% pref on these here, on the same investment. So that gives them time to build up the capital and reserve capital to be able to pay something like that.
Very, very interesting. So is there any message you have for anyone that is trying to start off raising funds? What is the thing you would have told yourself if you wish you knew from the beginning that you'd like to tell someone else that's just starting out in raising funds? What's that thing?
I would tell the person in the beginning, when you're raising funds, don't be discouraged. I say that I would have had every single right to be discouraged straight from the beginning based on how the first investment in the fund went. But that didn't stop me. What I did was I said, okay, let me fix this problem so that I can then go and make sure these investors know that, hey, this guy knows what he's doing. We can trust him. And we want to invest in future funds with him.
Hey, it was such an interesting episode with you, Joseph. I felt like going on and on because I have so many questions to ask you. But all right now,
we can always do a part 2 to this.
Yes, of course. I'm going to invite you, of course. That one is non-deal.
With that one, I'll make sure a conference room is available.
Yes.
That way people cannot speak.
Exactly. No, but fine. I'm sure the audience gained a lot, regardless of the noise coming out from your background. How do they connect with you if they decide to reach out to you? I'm talking about investors or people that just want to start out. How do they connect with you?
Yes, so the best way to connect with me is through Instagram, which is at Joseph Kimbrough, JosepKimbrouth. And then also my website, which is investinapartmentsnow.com. Or you can just put my name, josephakimbrough.com.
I know you're on LinkedIn. I don't know why you're not saying LinkedIn.
Oh, yes, LinkedIn also, which is Joseph Kimbrough.
Exactly. So you can reach out to Joseph on LinkedIn as Joseph Kimbrough. It's very responsive. And if you want to invest in his funds, reach out to him. And if you are looking for someone to guide you, also reach out to him. For next week, because we are approaching the end of the year, this is August. And right now, it's important that you start focusing on your taxes. So we'll be inviting somebody from the tax aspect, and they'll be giving us insight in-depth understanding of cost segregation and how that can help your investment. So our next series is going to be in 2 weeks' time. I will be inviting someone from the tax community, and they will be telling us all about cost segregation, tax liabilities, what are the things you should look out for, when you even start the process with them, and all that. If you have not subscribed to our YouTube channel, this is the time for you to do that. Our YouTube channel is Blue Ocean Multifamily Group, and we're also on Facebook as Blue Ocean Multifamily Group. This is where you get all your content. We spend time and energy, and we are putting all our experiences all into this content for you to continue your multifamily journey. It's an intentional endeavor from us because we want everyone to quickly, the more you have the education about multifamily, the more comfortable you'll be in investing. You don't want to invest without getting the right education, whether as a limited partner or as a general partner. You need the right education, and we have just that right education for you. And it is absolutely free of charge. So all you need to do is subscribe. Blue Ocean Multifamily Group. Thank you, Joseph, once again for taking out the time. We'd like to engage you again on this conversation. Thank you so much. And thank you everyone for being part of this. Please have a wonderful day.